Ethereum dominates tokenization. Over half of all real-world assets on-chain live there. Institutions trust it. Developers build on it. The numbers don't lie. But what if Ethereum's own architecture is setting up tokenization for failure? A crypto analyst just dropped a thesis that flips the entire narrative upside down, and it involves a network most people aren't even watching. We're talking about a potential $15 trillion market by 2030, and the battle lines are being drawn right now. This isn't about hype. This is about where your digital ownership actually lives. Welcome back to the channel. If you're new here, I break down the crypto market without the nonsense, just data, analysis, and a little bit of chaos. Hit that like button if you want Ethereum maxis to find this video, and subscribe because we're diving into tokenization wars, and trust me, you don't want to miss what's coming next. Let's establish the playing field. Ethereum isn't just leading tokenization, it's practically invented the category. ERC standards built the blueprint, DeFi gave it liquidity, stablecoins gave it utility. When institutions think tokenized real estate, bonds, or equity, they think Ethereum. ETH price movements literally track the tokenization narrative because the market sees Ethereum as the infrastructure layer for digital ownership. That's not opinion, that's market reality. But here's where things get interesting. A crypto enthusiast named Ivan Ivanov just published an analysis that challenges this entire assumption. According to Ivan, adoption doesn't equal suitability. Just because everyone's building on Ethereum doesn't mean Ethereum is the right foundation for what tokenization actually needs. And honestly, his argument has teeth. Ivan isn't attacking Ethereum's current dominance, he's questioning its long-term viability for something as serious as ownership records. Think about what tokenization really represents. We're not talking about meme coins or governance tokens. We're talking about your house, your investment portfolio, financial instruments worth billions. When you tokenize a land certificate or a corporate bond, you're creating a permanent digital record of ownership. That record needs to sit somewhere for decades, maybe centuries. Now ask yourself, would you trust that record to a network with centralized rollups? Would you sleep well knowing transaction ordering could be influenced by staking power or MEV bots? Ivan's argument is that Ethereum's architecture introduces trust layers that might be fine for DeFi trading but become problematic when you're storing trillions in real-world assets. And before you dismiss this as FUD, hear him out because his alternative is Kaspa. Yes, Kaspa. The network most people associate with mining and speed, not tokenization. But Ivan believes Kaspa's structure solves the exact problems Ethereum creates. He's not talking about Kas price, he's talking about network philosophy. Kaspa runs on a block-DAG architecture that delivers high throughput without centralized sequencers, without stake-weighted validators, and without the choke points that Ethereum relies on. According to Ivan, that's the difference between a chain built for trading and a chain built for permanent ownership. Let's break down why Ivan thinks Kaspa has the edge. Ethereum processes transactions through a single chain structure that requires validators to agree on block order. That's fine for speed, but it creates opportunities for manipulation. MEV, or maximal extractable value, lets validators reorder transactions for profit. Rollups introduce off-chain sequencers that control how data gets batched. Staking concentrates power in the hands of large holders. None of this makes Ethereum insecure for everyday use, but when you're tokenizing a $5 million property or a $100 million bond issuance, do you want any of those variables in play? Ivan argues that Kaspa eliminates these risks entirely. The block-DAG structure means transactions confirm in parallel, not sequentially. There's no single validator deciding what gets processed first. No sequencer controlling roll-up data, no staking mechanism that gives whales influence over network decisions. It's pure proof-of-work decentralization at scale, and for tokenization, where permanence and neutrality matter more than ecosystem adoption, that structural difference becomes critical. Now, I'm not saying Ethereum is doomed. Ethereum has liquidity, tooling, and institutional relationships that Kaspa doesn't even dream about yet. But Ivan's point isn't about today. It's about 2030. The tokenized asset market is projected to hit $15 trillion by then, with over half tied to real estate and financial instruments. These are long-term holdings. People don't tokenize their house to trade it on a DEX next week. They tokenize it for decades of frictionless ownership transfer. For that use case, network philosophy might matter more than network effects. Ivan expects KS to become one of the scarcest assets by 2030, which isn't speculation. It's supply dynamics. Kaspa's fixed issuance schedule means the network's economic base becomes predictable. For developers choosing where to build tokenization infrastructure, that predictability matters. You don't want your ownership layer sitting on a chain where monetary policy shifts based on governance votes or staking rewards get adjusted to manage inflation. You want immutability, and Kaspa offers that. Here's my take. Ethereum will remain the tokenization leader for years because adoption creates its own gravity. Builders go where the liquidity is. Institutions go where the regulatory clarity exists. But Ivan's argument exposes a genuine structural question. If tokenization grows to $15 trillion, and if that value represents irreplaceable ownership records, does Ethereum's architecture become a liability? Maybe, maybe not. But, the fact that Kaspa offers an alternative built specifically for neutrality and permanence means this conversation isn't going away anytime soon. So, let's talk about what tokenization actually needs. Speed matters, sure, but permanence matters even more. Ethereum can process thousands of transactions per second with rollups, but here's the thing. Those rollups depend on centralized sequencers. Kaspa confirms blocks every single second without that dependency. Now, Ethereum offers DeFi composability, which is, honestly, incredible for trading, but tokenized real estate doesn't need to integrate with lending protocols. It needs to sit securely for decades. So, Kaspa's block-DAG delivers that security without requiring users to trust validators or sequencers. Ivan uses a simple thought experiment to illustrate his point. Imagine you're tokenizing a land certificate. That certificate represents legal ownership of property. You need that record to exist in 50 years, unchanged and uncorrupted. Would you store it on a chain, where validators can reorder transactions, where rollups can go offline, where staking concentrations shift network control? Or would you choose a chain where no single entity can influence settlement? So, according to Ivan, the answer to this question really determines which platform is going to win the tokenization war. Ethereum actually built the entire category, and that gives it some pretty massive advantages. The ERC-20 and ERC-721 standards basically created the language for tokenization. Plus, DeFi brought liquidity to tokenized assets, and stablecoins made on-chain settlement way more practical. ETH price, honestly, reflects institutional confidence, and that confidence is what drives adoption. But, adoption doesn't always mean you've got the most optimal design. So VHS beat Betamax. Ethereum might dominate tokenization today, but, a better alternative could be building in the shadows. Kaspa's community points to decentralization as the key differentiator. The network doesn't rely on staking, which means no validator can accumulate outsized influence. And, well, the block-DAG architecture prevents MEV exploitation because there's no sequential ordering to manipulate. And proof-of-work mining keeps the network neutral, which matters when you're storing ownership records that governments and institutions need to trust. KS price volatility doesn't change these fundamentals. Network design does. Ivan's scarcity argument adds another layer to this thesis. By 2030, KAS is expected to reach near maximum supply, making it one of the scarcest Layer 1 tokens in crypto. So, scarcity doesn't directly impact tokenization functionality, but it does signal long-term economic stability. Developers choosing a platform really want to know that the network's monetary policy won't shift under their feet. Ethereum's monetary policy has actually changed multiple times. Emission schedules, EIP 1559, staking rewards, all of that. Kaspa's fixed supply removes that uncertainty entirely. Here's where I push back a bit. Ethereum's flexibility is also its strength. The network adapts to market needs, which is why it survived the DAO hack, transitioned to proof of stake, and it just keeps innovating with rollups and sharding. Kaspa's rigidity might offer stability, but it also means the network can't pivot if tokenization demands evolve. Ivan's argument assumes immutability is always better, but sometimes adaptability wins. That said, the $15 trillion projection isn't hypothetical. Real-world asset tokenization is already happening. BlackRock launched a tokenized money market fund, and JPMorgan tokenizes repo transactions. Real estate firms are experimenting with fractional ownership. These aren't crypto experiments, they're institutional use cases. And as that market scales, infrastructure choices become critical. Ethereum might keep its lead through network effects, or, Kaspa might carve out a niche as the settlement layer for high-security tokenization. Both outcomes are plausible. Ivan Ivanov's analysis doesn't claim Kaspa will replace Ethereum overnight. He's arguing that tokenization's next phase requires infrastructure built for permanence, not convenience. Ethereum is, optimized for speed and composability. On the other hand, Kaspa is optimized for decentralization and immutability. The market will, decide which trade-off matters more, but dismissing Kaspa as irrelevant to tokenization really misses the bigger picture. When trillions in ownership records move on-chain, the platform that offers maximum security without trust assumptions might actually win, regardless of current adoption. So, where does this leave us? Ethereum dominates tokenization today, and honestly, that's not changing anytime soon. But, Ivan Ivanov's argument introduces a structural question that, well, just won't disappear as the market grows. Kaspa offers an alternative built for neutrality, permanence, and decentralization, qualities that really matter when you're storing irreplaceable ownership records. Whether Kaspa captures meaningful market share depends on execution, adoption, and developer interest. But the thesis is solid enough that, honestly, ignoring it would be a mistake. If you want more deep dives into crypto infrastructure, check out my other videos, and if you're Team Ethereum or Team Kaspa, drop your take in the comments because I want to hear both sides. Don't forget to like, subscribe, and hit the notification bell so you don't miss the next video. Let's keep this conversation going. Quick reminder, this is not financial advice. Crypto is volatile, speculative, and risky. Do your own research, understand the tech, and never invest more than you can afford to lose. Tokenization is a long-term play, and both Ethereum and Kaspa come with risks. Stay safe out there.